Hello everyone and welcome to our second quarter 2026 AFC webinar. My name is Thomas Hooker and I'm the CEO and founder of Asia Frontier Capital, and I will be the moderator tonight or today. On the call today are Ruchir Desai in Hong Kong, who is managing with me the AFC Asia Frontier Fund. Ahmed Tabaqchali, the chief strategist of the AFC Iraq Fund, is in Baghdad, Iraq today. Scott Osheroff, the chief investment officer of the AFC Uzbekistan strategy, is in Uzbekistan, and Vicente, the chief investment officer of the AFC Vietnam strategy, joins us from Ho Chi Minh City today. This webinar will last about 45 minutes, and thereafter you will have the opportunity to ask questions during our 30 minutes Q&A session after the presentations. You can submit your questions online through the Q&A icon at the bottom of this Zoom video on your laptop, PC or mobile phone. And please note that this webinar is an overview of our investment strategies and investment universe and should not be taken as an investment advice. 2026 started with great performances in January and February. Especially our Uzbekistan strategy achieved positive performances in all 4 months, despite the turmoil in the Middle East in March and April. The Uzbekistan strategy was up 18.8% in January alone, and year to date the strategy is up 29.5%. Also, the Asia Frontier and Iraq strategies are both up year to date, and the Iraq strategy even reached a new all-time high at the end of April. The Asia Frontier strategy ended up April just a tick below the all-time high NAV. Another big development since the last AFC webinar was the upgrade of Vietnam by FTSE Russell from frontier status to secondary emerging market status as of 21st of September 2026. Ruchir, over to you for the outlook for the Asia Frontier markets and the AFC Asia Frontier strategy.
Thank you, Thomas, and welcome everyone to our regular quarterly webinar. So obviously it's been quite a year so far, as Thomas mentioned. The year started off on a pretty strong note for all our funds, especially the AFC Asia Frontier strategy. And then of course, as all you viewers will be aware, since 20th February 2026, we've had the conflict in the Middle East, which has led to a lot of uncertainty and geopolitical tensions in the region. But broadly, as this chart shows you, I think the returns have been quite broad-based across our markets. I mean, you had very strong performance for oil exporters in our universe. For example, Oman, as you see on the chart, it's up 42% so far this year in dollar terms, benefiting a lot from high oil prices, but also some other reasons which I'll talk about later. And Kazakhstan, also an oil exporter, up 21% for the year so far. But besides that, we've not had major drawdowns in our markets like you would expect because of the high oil prices or because of the conflict in the Middle East. I mean, for example, Pakistan and Sri Lanka are down about 1 to 2%, so it's not as significant as, say, for example, the corrections you're seeing in Indonesia and India, which is at the bottom right of the chart. India and Indonesia have corrected quite heavily so far this year. And broadly, I think March was a pretty weak month for our markets. You saw large corrections in Pakistan, Sri Lanka, Vietnam. But again, as we anticipated, if there was some de-escalation in the conflict, which we saw in the form of a ceasefire, which is, you could say, fragile or still working. April saw the announcement of the ceasefire, which saw a very strong rally in many of our markets, and that's why they recovered many of the losses in April. And because of that, I think now even the AFC Asia Frontier strategy for the year so far is up 4%, which is not bad given the fact that we were down in March. The fund lost about 7.7%, and we made up most of it in April, about 6.4% gain. So broadly still positive for the year, and so far this month in May we are kind of flat. So given the situation and given the impact of high oil prices on some of our markets, it's not a bad performance or pretty stable performance despite the uncertainties. And broadly, I think de-escalation was very important for our markets, and I expect that if de-escalation continues, I'm not an expert on what's going to happen in next 3 or 6 months in terms of which way the discussion between Iran and the US go. But broadly, if de-escalation remains the theme, then I think that's going to be positive for our markets. Next slide, please. And just to quickly talk about the impact on our markets as well, I think a lot of the media has made a lot of noise about the high oil prices and the impact on oil importing countries, especially in South Asia and Southeast Asia. But if you look at this chart, the currencies have been broadly stable. I think the worst kind of currency performance we've seen in our markets is from Sri Lanka, currency depreciation of about 4% so far this year, which is not massive. I mean, 3 to 5% currency depreciation is normal for any emerging market. And I think India's currency depreciated by 5 or 6% this year. So given the scenario, given the situation, I think it's acceptable. And also you have to remember that Sri Lanka is coming off a couple of years of very strong performance from its currency, from its stock market, from its economy. So having a bit of flat performance, I think taking a bit of breather is okay. And at the same time, you're seeing oil exporters like Kazakhstan, they've seen the currency appreciate, but broadly currencies have been stable. And the reason is because broadly macroeconomic position in our countries is much stronger compared to 2022. So when the conflict began in end of February, yes, it was a concern. I don't want to make it sound rosy. There's no impact on the economic growth or inflation and all the other economic metrics for our universe or for in general for markets globally. But many key countries in the US, especially South Asia like Bangladesh, Pakistan, Sri Lanka, and even Vietnam, their macroeconomic position is in a much stronger position compared to 2022 when the war in Ukraine broke out. All three countries, Bangladesh, Pakistan, Sri Lanka, are in IMF programs. They weren't in IMF programs in 2022. The macro is much more stable, higher foreign exchange reserves. In fact, Sri Lanka has shown a current account surplus for the last 12 months. Pakistan showed a current account surplus for the first quarter of 2026. Bangladesh has shown an improvement in its current account balances over the last 6 to 9 months. Foreign exchange reserves in all three countries has improved quite significantly. Even Vietnam, which had, for example, the noise from the tariffs last year and the real estate and banking crisis they had in 2022 and 23, they've overcome that 8% GDP growth in Vietnam last year and about close to 8% GDP growth in the first quarter of 2026 as well. So broadly, pretty strong macroeconomic footing for all these countries, and also more importantly, there's a lot of political stability in our country. So in 2022, countries like Bangladesh, Pakistan, Sri Lanka, even Central Asia, Kazakhstan went through a bit of a crisis politically in 2022 as well. Many of our markets are now much more politically stable. Bangladesh, Pakistan, Sri Lanka all had parliamentary elections in the recent past. They all have stable governments, which are in majority. So that's a very important factor as well. So both political stability, macro stability, and that's why you've seen currencies remain broadly stable, and you've seen the market come back quite strong in April despite the correction in March of 2026. Next slide, please. Yeah, and broadly, I mean, just a big picture view, we've had so many uh, economic/geopolitical shocks over the last 5 or 6 years, where the pandemic in 2021, 2020 and 21, the war in Ukraine 2022, the very aggressive US fair in 2022 and 23. We've had the escalation, the conflict in the Middle East, which, by the way, is going on since October 2023, obviously just escalated quite significantly in the last 2 months. But despite all these shocks, the returns from our markets have been quite solid. As the chart shows you, the AFC Asia Fund strategy over the last 5 years, annualized terms, total returns in USD has been about close to 11% and outperformed all the major emerging and frontier market indexes. So again, this reflects the resilience of our countries, the stronger macroeconomic political position, but of course, also the fund management, our investment strategy of focusing on top-down country allocation, and of course, more importantly, stock selection, which has led to these returns. Next slide, please. And as I mentioned to you about Omar in my opening comments, it's been a standard performer so far this year. I would say globally, not just in the Middle East. The Muscat Stock Exchange Index is up about 42%, or is up 42% in dollar terms so far this year. Very strong outperformance against most of its peers, who are quite negatively impacted by the conflict in the Middle East. Before even the conflict began in the Middle East, Oman was in a much stronger positions. For example, when the pandemic happened in 2020-21, Oman's macroeconomic position took quite a hit compared to, say, Saudi Arabia, UAE, or Qatar. So they had to do a lot of hard work and a lot of reforms. So the last couple of years have done that. The debt to GDP levels have come off by half in the last couple of years. The debt to GDP is now about 30% from about 60% during the pandemic. The government has a Vision 2040 program, which is focusing on non-oil GDP growth, which is growing about 4%. Oman is the first country in the GCC to introduce income tax, obviously for high income earners. I think anyone who earns more than $100,000 a year will have to pay 5% income tax, which I think will be a trend for many of the other GCC countries who have taken a big fiscal hit from the conflict in the Middle East. So those are reforms the government has been doing. Many state-owned companies have been IPO'd in the last probably 12 to 18 months. I think six of them, and these are all large caps, have been IPO'd on the local exchange over the last probably 12 to 18 months. And because of the improvement in the market cap and improvement in liquidity, I believe Oman is up for an MSCI emerging markets upgrade shortlist in the next couple of years. So if that happens, if the shortlist news comes through that MSCI will be upgrading Oman to emerging market status, you will see with more flows going towards the large caps. And our strategy is well positioned. Yes, it's a small market. Our allocation is about 3%, but we have three large cap companies, a bank, a telecom company, an oil and gas player, all of which will be exposed to these inflows if the emerging market story comes through. And coming to the conflict, I think, a couple of months ago, maybe 6 weeks ago, when Dubai and Doha had its airspace closed, or UAE and Qatar had its airspace closed, besides Saudi Arabia, Oman was the only country which had its airspace and sea lanes open. So I think that's benefiting them from a just reputation perspective. I think you can see more transit of passengers and cargo going via Muscat or Oman. I think even now, basically geographically, Oman is in a much stronger position. They're outside. If you look at the map, Oman is outside the Strait of Hormuz. So yes, I know there's a blockade by Iran and US in the Strait of Hormuz. I'm not sure how much of Oman's oil is getting out, but I think it's definitely more of Oman's oil is getting out compared to say, UAE or Qatar or Bahrain or Kuwait. So before this whole blockade noise began, in the first probably 6 weeks of the conflict, Oman was doing 100% of its pre-war oil exports, while the rest of the GCC, UAE, Qatar, Bahrain, Kuwait was doing about 10 to 40%. So make it for the other countries, but Oman was still going through. And also geopolitically, Oman is neutral compared to their neighbors. So that's a very important point going forward. I think it'll become more important going forward because I think it's quite evident that the uncertainty of Iran or the geopolitical uncertainty of Iran is here to stay for the near term. And I think because of that, countries in the GCC, which have taken a hit from the conflict, I think their valuations will face a geopolitical discount, similar to what we saw after the war in Ukraine, when stocks in Kazakhstan, Georgia had a geopolitical discount. So I think same thing will happen to stocks in UAE, Qatar, etc. I'm not an expert, but that's my view. And I think Oman, because of the fact the macro is much stronger, and they're in a much stronger position to recover from the conflict. I think you could see valuations re-rated in Oman. We've already seen that come through so far this year with the stock market return, with the market up 42% so far this year. So I think Oman is a country to watch out for in the region over the next 3 to 5 years. Next slide, please. And also, yeah, many people talk about the impact on South Asia and Southeast Asia for high oil prices. But within our universe, you also have some countries which are, yes, impacted, but not so bad, or not so badly, or not as negatively as, say, South Asia or Southeast Asia. So Georgia and Uzbekistan, their GDP growth is really standing out now. So if you look at this chart, the last columns, the first quarter of 2026 GDP growth in Georgia was 9.1%, and Uzbekistan was 8.7%. Obviously, Scott will talk to you more about the Uzbek story, but economic growth is pretty much on a roll in both countries. Yes, you'll see a bit of an impact in Georgia in the second quarter because of tourism numbers coming down post the conflict in the Middle East. But I think the estimates are still for about close to 8% GDP growth for Georgia this year, and I think similar 8% GDP growth for Uzbekistan. So very strong momentum in Georgia, especially Georgia. You're seeing a very strong export growth coming through Georgia. Again, Georgia is benefiting from, which I've been talking about previously as well. Georgia is benefiting from the movement of goods between East and West via Georgia, because Georgia also has a Black Sea coast. Previously these goods were moving via Russia, but now they're going through Georgia as well. That's benefiting them, and of course, tourism has been doing well. But of course, I think we should remain a bit soft for the next few quarters. But broadly, strong tourism momentum in Georgia as well, and overall strong momentum in the economy. So I think these two countries, Georgia and Uzbekistan, also we have a good exposure. The strategy has a weight of about Uzbekistan's strategy second biggest weight about 14%, 13.5%, and Georgia at about 6%. So I think these two countries also will stand out, I think, next couple of years. Next slide, please. Yeah, so as I was mentioning to you about the country allocation, the reason I put this chart is here is not that the strategy is focused just or very heavily exposed just to oil importing countries. Oil exporting countries, quite well balanced. So it's not like we have 30% weight to Pakistan or 30% weight to Sri Lanka or a 40% weight to Kazakhstan or Iraq. It's quite well balanced across countries. Because broadly, I think over the last few years, as I mentioned previously on the webinars and in the managed comments as well, we are very positive across the universe. We're not just positive just on one country or country A, country B. I think in general, across our markets, we're seeing economic momentum, we're seeing reforms, we're seeing economic stability, political stability, attractive valuations. And that's why I think you're seeing this balanced exposure across our markets. And even in April, when the fund did well, came back from its drawdown in March, it was an all-round performance. It was across markets: Pakistan, Sri Lanka, Vietnam, Georgia, Kazakhstan, Uzbekistan, Iraq. So broadly across the board, we've seen recovery. Again, coming to my point, we are positive across our markets. And again, we are well balanced between all exporting countries and all importing countries. And that's why you've seen a pretty good performance in April as well. Next slide, please. Yeah, just coming to valuation, as I mentioned, valuations are quite attractive. As this chart shows you, the NAV for the fund is pretty much back to its all-time high, that we hit in January 2026. But P ratio is still close to all-time low. P ratio of 7.3 times versus I think close to 17 or 18 times in 2017. But again, the catalysts are in place. So I'm not so, as I mentioned earlier in my comments, early in the talk in my discussion as well, I'm not so concerned about our markets, compared to 2022. The macro is much stronger, the politics is much stronger. And that's why in my view, the catalysts are in place. Valuations attractive, and the catalyst in terms of potential continued Middle East de-escalation, if that continues. Earnings growth is still coming off a low base from the last few years. We have stable macro and stable politics, and the reform momentum continues. Again, coming back to my point, across the markets, we see positive momentum, and any kind of uh, correction because of the ongoing conflict in the Middle East. I think, in my view, the markets will come back. We saw that in April compared to the March correction. And if that happens again, say in May or June, I think the recovery will come through pretty soon. And one reason is because there are not many foreign investors in our markets. I mean, you've seen a lot of foreign outflows go out of many larger emerging markets in the region like Indonesia or India. But in the foreign participation in our markets, for example, in Vietnam, it's 8%, in Bangladesh, Pakistan, Sri Lanka, it's 1-2%. So if you have, a weak geopolitical situation or geopolitical tensions, I don't think I mean, it's not, the foreign participation is so low, you won't see major outflows. And there's enough domestic liquidity. Interest rates are still much well below all-time highs. So I think locally domestic investors view any correction as a buying opportunity, and that's what we've seen in the last few months or the last year or so. Next slide, please. Yeah, so just continuing, as I mentioned, I think reiterate again, being on the ground is very important for us. Sitting in the office, doing a Zoom call or what, being on Bloomberg is obviously one way to find stocks or look at ideas and understand companies, but going on the ground is more important for us. So I was in Bangladesh a few weeks ago. So I was in the metro. It's a new modern metro built by Japan, I believe. Completely modern, all air conditioned. It's as good as any metro you would see, say, in other emerging markets like Vietnam or India. And that's on the right hand side, extreme right is just a street snapshot on Dhaka, and the shop Walton you see over there in highlight, which is in it lighted up, is basically a consumer electronics company, which is the largest consumer electronics company in Bangladesh, and we are shareholders. And I'd gone to visit their store to see what kind of products they have. So this is just a snapshot of what we do. And of course, on the left is again consumer electronics slash grocery retailer in Vietnam, the largest, the mobile world. And again, we go on the ground, go to the stores, etc. I just get a feel of what's going on. So yeah, I think we won Vietnam and Bangladesh so far this year. Thomas and me will be in Sri Lanka next month. I'll be in Georgia as well next month. And just a bit of a marketing comment. I'll be in the US starting from this Friday for a week. So if any of you are in the US and are listening to me right now, if you want to catch up with me in LA or Miami, Houston or New York, just drop us a line and happy to catch up with you. Next slide, please. Yeah, I just want to wrap up by saying that, I want to reiterate that I'm not, given what's happened, there's a lot of geopolitical noise and uncertainty of what's going to happen in the Middle East or Iran, etc. But again, I just want to say that our countries, our universe, is in a much stronger position from a macro perspective, from a political perspective. So I don't see the kind of drawdowns we saw in 2022 from our stock markets, or the kind of currency depreciation we saw in Sri Lanka or Pakistan or Bangladesh that we saw in 2022 or 23. I don't see a repeat of that. The macro indicators are much stronger. As I mentioned, the valuations for the fund 7.3 times. The earnings growth for the last 5 years for our companies is about 24% in annualized terms, very strong. Earnings momentum, return on equity about 25%, not much debt. For example, Vietnam, again, very strong GDP growth outlook, as Vicente will mention to you. As I mentioned to you, Georgia and Uzbekistan are a very strong position. And of course, we have all exporting countries in the universe like Iraq, Kazakhstan, Oman. And of course, I think Oman being an emerging market, a great story, I think that'll be more in the limelight over the next 1 or 2 years. So broadly, once the clouds of the Middle East conflict are lifted, I expect the momentum to continue for the AFC Asia Fund strategy. And even last year in 2025, first half was weak for the strategy and second half was much stronger. And I think that's kind of playing out this year as well. First half so far plus 4% and up to April. But I think second half should be better, given that the catalysts are in place, and hopefully we see some further de-escalation in the Middle East, which should drive returns. So, with that, I would like to hand over to Ahmed Tabaqchali, who is the chief strategist of our AFC strategy. Over to you, Ahmed. Thanks.
Thank you, Ruchir, and thank you all, and welcome to the AFC Iraq strategy. Well, I mean, Ruchir was talking to you about tension in the Middle East and stuff, and where, when Iraq comes in, it's actually almost like the poster child for a conflict in the Middle East. And given what you all know, I thought actually to discuss a couple of things, really, basically. The first is what is perceptions on Iraq in terms of reporting on the damage from the effect of the closure of the, as well as what is actually happening in Iraq across multiple fronts. So obviously, as most of you might have seen, and pretty much I've almost read every newspaper or report on Iraq as soon as the war started, and basically they all say the same, which is are true, and basically that's oil exports account for 90% of Iraq's total exports, roughly, something like that. 94% of these oil exports go through the Hormuz, and obviously, with the closure of the strait, the economy is bound to die, kind of thing. So the reports that you hear, I've seen multiple headlines from the word like Iraq's teetering economy or Iraq's economy on the verge of collapse across the newspapers and stuff. It's all doom and gloom reporting, based on some truth, but not the whole one. And that's what I hope to show you. So next slide, Peter, please. So basically, while these reports are ongoing, in Iraq, things are quite different. So the first one I start with is the equity market. And as you can see, since the start of the conflict, which is on the 28th of February until the end of April, the index, the RSIX USD dollar in dollar terms, was up something like 7.8% since the beginning of the conflict, and something like up 8.4% year to date, on top of up being 224% for the last 3 years. Similarly, for the AFC Iraq strategy, up 8.1% in that timeline. Year to date, we're up 9.4 and something like 253 for the last 3 years. You would think if any country that is one perceived to be the theater of conflict, always is whenever the US and Iran conflict or disagreement always happens, Iraq is always thought of as the proxy war or the proxy arena for that to happen. You would think that people after 3 years of excessive gains, they might very well decide to go for profit taking. None of that has happened. There's no indications of that. In the meantime, Iraqi companies, specifically the banks, have been generous yet again. Last year was a gangbuster year for dividends, and this year looks like a replay of that, given that they are supported by company earnings. So you have Mansour Bank was the first to come out in March with a combination of stock and cash dividends of 19.5%. Followed by National Bank of Iraq, cash and stock dividend combination of 9.5%. Then Bank of Baghdad a few days ago, or something actually last week, cash dividend of 12.1%. The interesting thing, by the way, about the combination of cash and stock dividend for the last two companies, and it's really worthwhile mentioning, is in 23, the central bank mandated that banks should increase their capital. And that's what drove the combination of cash and stock dividends for the last couple of years. In this case, both of these two banks have capitalized in excess of the central bank's minimum requirement, and the current increase in stock dividend increases the capitalization even further, primarily because they see a significant opportunity. So the figure, the central bank is 400 billion, and one of those companies is over 580 billion. The other one is close to 100 billion. So it just gives you what these companies think. Next slide, Peter, please. And meantime, looking at the other indicator of the market, and that's looking at the currency market. Here, I'm looking at the parallel market of the Iraqi dinar versus the official price, as well as the percentage difference. And, both of them would follow the same line. And as you can see, again, since the start of the conflict, if anything, the parallel exchange rate went sideways to slightly down, which again shows no sign or indication of any panic. In the past, up to 2020, and up to COVID, always was, that would spread increasing. That has not happened here. Next slide, please. So the third, meanwhile, in Iraq is basically looking at life in the city. I've, as some of you might know, I go back and forth a lot between Baghdad, Slaymaniyah, as well as other parts of the world. And recently on a trip to Baghdad, where I am right now, I was looking for that teetering economy or that economy on the verge of collapse or what have you. I've seen nothing, at least in terms of, I've seen in company earnings, and I've seen the strong earnings by our holdings as well as by the companies in general, but the life in the street, I mean, I went on a long walkabout in a wonderful part of Baghdad called Yarmouk. And at 1 a.m., I was quite hungry. That's 1 a.m., obviously. And I go onto my favorite place and it was full of people. And not only, let's say, adult, but families. And the point I'm trying to highlight is, there is a huge difference between perceptions of what goes on in Iraq or perceptions of Iraq's economy and Iraq's economy as seen from consumption, because that's what really drives most economies. Next slide, Peter, please. So basically, one would ask, what gives? What is this disconnect between what people think, or all those masters of the universe who report on Iraq from the outside, what they think Iraq is doing, and actually what is happening? In my opinion, there's a number of factors that explain that. The first is government finances. Yes, the closure of the Strait of Hormuz is real. Yes, it is extremely damaging to Iraq. That's no doubt about it in terms of government finances. And again, I'm not brushing away these things. I'm not making light of them, but I'm trying to highlight the differences between what is real and what is perceived. Maybe sometimes a bit excessive in terms of taking the make as they say. Now, basically, yes, but keep in mind, oil revenues are paid 2 or 3 months after they're made. So in the case of Iraq, March and April are more than fine. The crunch comes in May, and that's clear. That's for the government. There is going to be a crunch coming, but hey, this is a government, not a grocery store, and therefore the government can borrow domestically quite significantly. So that is definitely there. We hoped for opening of the Strait of Hormuz, and I think economic logic, and that's speaking logic, not emotion or ideology, argues for the opening of the strait. And just today, by the way, we've mentioned in the last few reports that Iran is allowing Iraq to ship some of its oil. And today was reported by multiple sources that 3 super tankers carrying Iraqi oil have passed through the strait. So there is a light at the end of the tunnel, even before the tunnel opens up for everybody. Next slide, please. And again, what gives is an argument that we've been making here for quite a while, and I'm not going to belabor the point, but just mention the argument that drove the market's performance is the same one here. It is happening. The economy is transforming. We've argued that one big driver of that has been the relative stability that the country has enjoyed. I think that is clear. I can see it on a daily basis, and anybody who comes to Iraq would cannot fail but see that. And the other one is the structural banking transformation, which is quite significant. And that is, by the way, what is driving the bank's powerful earnings, very strong earnings, as well as their extremely high dividend rates. Next slide, please. I hope I haven't taken too much. And basically, again, what gives in my mind is, for me, as somebody who's been looking at Iraq since 2007, but for the strategy since 2015, is that the same argument. We've argued then that the Iraq story is, yes, Iraq's risk is high. Yes, it's very high, but perceived risk is substantially higher. And the argument was that there's a delta to be arbitraged. And we've seen that partly. Given the fact that what I've just mentioned right now, the difference between what is happening in the ground in Iraq in terms of the currency market, in terms of the stock exchange, in terms of daily life, in terms of the general stuff that one sees, and the perception of the world worldwide, that in my mind, that delta is still wide. So not only do I see a recovery in Iraq continuing, but I see that being sort of almost helped by the discount that by the perception where the delta comes down and as prices will move up. So same has not changed. And by the way, just going on that, Iraq's obituary has been written a ton of times in the past. 2014 when ISIS came, and that's when we launched the Iraq strategy. It came in years later in 2020. It came in, and even the same signals that I am taking comfort in, they are the same signals that point out to us at the time when the war on Gaza happened, post October 23. The same signals that I'm citing were there then, i.e., the currency, the exchange, all were pointing to the same thing that I'm seeing right now. Next slide, please. And again, I'm not going to be belaboring that point, but definitely what drove this performance over the last few years has been these factors that I've mentioned. And just one highlight is, yes, oil is crucial for Iraq. It definitely is a big play. And I'm not making light of it or discounting it, but definitely the story is more than oil. The evidence of that would have been seen last year. Brent prices were down 15.3%, yet the AFC fund Iraq strategy was up something like 17%, while the index was up just under 14%. So yes, the current closure would strain finances, would pressurize the economy, pressurize government, have long-term effects. But however, the economy is moving forward, and that's the point I'd like to raise. Next slide, please. I'm not taking too many slides, but again, if one looks at what next for the world at large and what next for Iraq, in my humble view, that the world is going to be very different post Hormuz, no matter whenever the strait opens. The way I see it is that there's going to be a risk on oil prices, and also I see that the fact is once the strait opens and people begin to export through that, there would be a rebuild of inventories and maybe a larger rebuild of spare inventories worldwide. And I think that will make the world more expensive. Inflation is going to be a factor, but for Iraq is somewhat positive. And I'm saying somewhat because higher oil prices obviously would be a boost. As I said, higher oil prices would provide a boost. Low oil prices would dampen the sector transformation. But it will help with perception, and also it will help definitely with government finances. The fact that the government would borrow short term and borrow a great deal has consequences in terms of inflation and what have you, but definitely higher oil revenues will make that a one-off and help partially restore government finances and revenues. And I think the last slide, if I remember correctly. Now, in conclusion, again, I'm not making light at all of the seriousness of what goes on in the Middle East, but I would like to highlight, as I said, what we're seeing on the ground in terms of the performance on the ground, in terms of the currency, in terms of daily life consumption and so forth, really has got no connection whatsoever with the perception outside Iraq. And that's what we want to highlight. And again, the dynamics that's been discussed over the last few months are still there. We believe they will still continue to ride the market and the performance. And again, my feeling is that they are dampened when things are bad, like now and last year. But it's almost like a cold spring. Once the changes, it will accelerate that movement. And however, one cannot hide the fact that the current, peace no war deal is fragile, is extremely fragile. Even though in my mind, I believe that economic logic dictates on both parts that there should be an end, but that's economic logic versus ideology, which is a factor in both sides, could be a risk and could hurt the region considerably. And with that, I thank you for your time, and I passed on to my colleague Scott, who looks after our Uzbekistan strategy. Thank you all.
Thanks, Ahmed. Good day, everyone. So let's go back in time to 2018 when we first went to the country. My view from then, once spending time in the country, was what's on the left-hand side of this presentation. And lo and behold, it's actually come to fruition. So back in 2018, you had inflation, 15%. The currency depreciated that year, I believe, 19%. And no one had any interest in investing in the stock market. So what's happened since, as you can see a bit with the chart on the right, is that inflation has come down to 7%. The currency is stabilized. It was up just under 7% last year.
It's flat this year, which is a sea change relative to the past. And the cost of capital as a result has decreased in Uzbekistan, and you've seen a huge credit boom in the country. You've also seen sovereign bonds, appetite for sovereign bonds listed in London be very strong, typically 4 times oversubscribed. And in line with all of this is the cost of capital has slowly but surely come down, though in the past 2 years it's happening at an accelerating pace. Bank term deposit rates have fallen from the mid 20% range down to the teens, and this has translated to local capital beginning to move into the bond market, where 2 years ago there was effectively no bond market. There were a handful of corporate bonds, but really, when I say a handful, I mean like 2 to 3 per year if you were lucky, and size-wise, 1 to 2 million if you were lucky. So there was no corporate bond market. This has changed significantly. You have a company called Uzum, which has just done a $40 million bond, which will be listed domestically. And as a result, is the cost of capital's come down. You've seen money move into the corporate bond market, and that's developed. You're now seeing money move into the stock market. And this is one of the reasons that in March of last year, the stock market bottomed, and we're seeing the performance we're seeing, which we believe is still early days. The problem is that after 2 or 3, I honestly forget at this point, privatization programs that were announced over the past few years that literally just fell into the ether, we now have a privatization program that is functional, and UZNIF, which I've talked about in the newsletter, the Uzbekistan National Investment Fund, the book build closed an hour and a half ago, and they'll be listing in London and Tashkent on Monday of next week. So we're finally at the stage where we're seeing SOEs beginning to list, and I think that after a few of them list, it won't be a shocker to see some private sector IPOs occur in the market again, as you see more liquidity and interest. So the pieces are all finally falling into place after a very long wait. Again, performance hasn't been terrible, especially in the past year, but the future looks very bright. Next slide, please. So to talk about a bit about rate compression, what you've seen, as I mentioned, is that rates have been compressing at a accelerating pace. In 2024, Uzbekistan was borrowing money north of 15%. And they did an issue in April last month, which was a record low in Uzbekistan at 12.25. Typically, all of their sovereign bonds are oversubscribed for by about 4 times. And whether it was 16, 17% or 12.25, again, oversubscribed. And the fact that the currency is being stable and appreciating last year is a further tailwind for that. Again, corporate bond rates, you've seen them go from a year and a half, 2 years ago to being issued in the 25 to 30% range, 25 to 29%. Uzum just raised capital through a corporate bond at 19%. So huge moves in a very short period of time. And again, you're seeing the same thing in bank term deposit rates. 4 years ago, TBC Bank out of Georgia, which has a local subsidiary, was offering accounts in Tashkent or Uzbekistan at 26% compounded monthly. Now the average bank term deposit rate is 18.1%, down 90 basis points month over month. So things are happening quickly. And again, focus is beginning to shift to the stock market. And that's right where we are. Next slide, please. So the Uzbekistan National Investment Fund. This is the vehicle being managed by Franklin Templeton, and it's effectively 13 SOEs, which is the entire economy, ex mining. So unfortunately, no gold, copper, uranium. It looks like we might see Navoiy uranium, which is effectively the Kazatomprom of Uzbekistan, be listed at some point. They've shockingly been doing some road shows, so it seems that time will tell with the gold company, Navoiy. Al-Malik for copper, probably not, but Navoiy uranium might actually IPO in due course. So UZNIF, they'll be IPOing roughly 30% of the company at officially a 20% discount to NAV, but the government has accelerated its reform process. And Uznev holds companies in electricity production and distribution and gas distribution, so broad energy infrastructure. The government has liberalized the tariff mechanism to make sure that investors in electricity and gas infrastructure can basically make enough money to justify their investment and get a decent return on capital. This liberalization was supposed to happen in 2028, but it actually happened the same time that Uznev announced on the 29th of April that they were launching the book build. They brought it forward a year and a half. And this is expected to add roughly 15% to NAV, which will be calculated every month. So again, the vehicle will list next week on Monday, and then the first NAV report we'll have will be the end of May. So super attractive, a slew of companies tied directly to the core of the economy, which are all being restructured and cleaned up from board level all the way down to management being restructured and making these companies run efficiently and increasing profitability. After Uznev, the plan is for Uzbekistan National Airways, which 25% is owned by this holding company, Uznev, to list. Either Uznev will carve out 25%, or the government will take their 25% or 25% of what they own and enlist it. Now, for those of you that have been following Uzbekistan for a while, timelines are relative. Again, there have been a few prior privatization programs that fell on deaf ears. If Uzbekistan Airways can IPO sometime in the second half of 26 into the first half of 27, realistically the first half of 27, that would be ideal, rather than a bunch of talk about it and then it either disappears or it gets dragged into or pushed into 28 or 29. So in the next year, we potentially have IPO number 2, which is very likely to be Uzbekistan Airways. Again, dual listed between London and Tashkent. And then after that, the government has a slew of other IPOs. The hydroelectric company, Uzbek Telecom. Again, there's speculation among myself and others that Naval Uranium could list. Time will tell. I was speaking with the journalist yesterday, and the discussion was, who's next to list? And I said, let's get Uznev done. We've been waiting so long for these government SOEs to start. Once we get some of these under our belts, we should get a few more. And then in due course, inshallah, we get private sector IPOs. Again, it's a process, but we're moving in the right direction, and the pace of change is accelerating. So it's very much exciting times in Uzbekistan. And with that, I'll pass it off to Vicente Nguyen, the CIO of our Vietnam strategy.
Thank you very much, Scott. Go to the next. So, welcome. Good evening, everybody. I would like to share with you the very successful story about Vietnam economy in 2026. As you know, the war in the Middle East already created an oil shock for all over the world. Of course, Vietnam cannot stand outside of this damage. However, the government really control and put everything is manageable. So in the first quarter of 2026, the country GDP growth reaches the highest in 15 years at 7.83%. This is really, really high level, except for the first quarter in 2018. And in April, the new government also set up. The new prime minister and the whole his cabinet continue to keep the targets, very ambitious targets of the GDP growth in the next 5 years, regarding us on the global geopolitical crisis at 10% per year. Yeah, this is really, really high. It's so that the government is really confident and very determined to achieve 10% and push the countries at very high level growth. The high economic growth is the most fundamental base for the stock market and for the stock market and everything to develop the country. Go to the next, please. Another good news for Vietnamese stock market is Vietnam was finally upgraded to the emerging markets by FTSE. So according to Morgan Stanley, the total capital inflow into Vietnam is roughly around $4.6 billion from active funds, 1.4 billion from other index provider, and $700 million from FTSE. And the capital is expected to flow into the stock market since September 2026. So this is a good news and a new momentum for the whole stock market, not only for the market, but also for the local individual investor. This is really create a really good investment sentiment for local individual investor who contribute roughly around 90 to 95% of daily trading value every single day. Go to the next. And I also announced that the AFC Vietnam Fund has really strong portfolio earning growth in the first quarter. We already has extraordinary earning growth of the top 10 portfolio. For example, the largest position, MPC, is the largest shrimp exporter in Vietnam. It's also the largest shrimp company in the world. The net profit increased nearly 500% in the first quarter due to the very high demand from US, really high demand from Europe and Australia and Japan. The revenue of this company in the first quarter increased more than 100%. Yes, more than 100%. That's unbelievable because, you know, Vietnam's shrimp exporting right now had really favorable environment when Indonesian shrimp has banned because of the best stuff in the shrimp, and other country, our competitor like India and China has, how to say, very high and difficult obstacle in terms of exporting their product to US. Besides MPC, you can see that on the other of top 10 has amazing earning growth in the first quarter. However, the stock market really doesn't reflect the earning growth of the portfolio and the enterprise on the stock market. The reason why is create a super undervalue of the portfolio. Go to the next, please. So if we look at the valuation of our top 10 position of the portfolio, the MPC, the forward P is roughly around 5.7 times on earning. This is completely undervalued. Other stock are roughly around 5 to 6 times most likely, and only SSI is the largest broker in Vietnam, has the valuation of 12 times on earning. But because this company has a very high growth in the last 5 years, it's grow roughly around 20 to 25% every single year. So 12% is not really expensive at all. So because the market doesn't reflect the fundamental base of the whole market, not only Vietnam AFC Vietnam strategy, so it's created a really undervalued situation of the market and our portfolio as well. This is also a good opportunity to invest into the fund. Myself, the CEO of the Vietnam strategy, I just invested my 33rd consecutive investment into AFC Vietnam, to show my commitment, long-term commitment with the fund. So thank you very much for listening.
Thanks everybody also for your, as always, interesting and insightful presentation. We will now answer some of the many questions we have already received from the participants, but you can still submit more questions during this Q&A session through the Q&A button at the bottom of the Zoom screen on your mobile phone or on your desktop. We have received here 2 questions regarding the currency or FX risk in Uzbekistan. So Scott, so one is, what sort of FX risk do you see in Uzbekistan given the shortage of actual fiat liquidity in favor of a large gold holding, which the government doesn't seem likely to sell? And then Additionally, we had a similar question. Would you think the recent rally of the Uzbek som against the US dollar is more likely to be tactical or rather temporary shift, if you will, rather than a structural one? Recent gold rally, concentrated remittances, and central bank gold reserves also at record levels. So, yeah, interesting questions from two different participants.
So historically, the currency has depreciated because of the current account deficit. In the past, and therefore the government has sold copious amounts of gold. I believe in 23 they sold roughly 6 billion worth of gold to defend the currency. For the time being, that hasn't happened, and that's because remittances are roughly 20 billion. You've got FDI coming in, and effectively demand for SUM is higher than it's been in the past, more than dollars right now. So, and of course, the tailwind of a rising gold price is very good for the country. So they haven't, which is refreshing. They have decided not to sell gold until they need it, but they're certainly not holding on to gold forever. They will sell it when they need liquidity. That's very obvious. They just don't need liquidity now. So the currency has gone from one of, again, defending it by selling gold to support the currency, to buy SUM, to in the past year or two, in some instances, selling the SUM to try and weaken it. Because the country, if you look at historically, the currency has roughly tracked the Russian ruble, the Kazakh tenge, from an export angle. So if you had depreciation in typically Russia, you'd have a follow-on depreciation in Kazakhstan and Uzbekistan. Now the government's focus on trying to not let it appreciate too much because it will destroy the export sector. So the table has turned where, again, you've got rising gold prices. You basically have a Goldilocks scenario. Will it last forever? No, of course not. It's a frontier market. But the fact that they have gold helps them a lot. So it's very nice that the currency appreciated last year, is flat this year. At the very least, FX volatility will, into the future, I imagine, stay diminished dramatically relative to what it used to be, where you had, again, 10-15% depreciations in a year, depreciations. So I would still expect slight volatility, and ideally what we've always targeted is 3 to 7% annual depreciation, because they need it, one, to maintain competitiveness with the broader region, but again, they've got gold, and right now they're in a Goldilocks scenario, with remittances as well, and the FDI. So we can see how much further it goes, but I don't think that you have 10 years of Dutch disease in the country, because it would be very problematic for them. And again, they have the balance sheet via the gold to keep the currency in check if needed.
Okay, great. Yeah. Then we are not investing in Indonesia, but we have two questions regarding Indonesia. So one is, how do you think about opportunities in Indonesia? But as I said, we are not investing there. But Ruchir, anyway, maybe your thoughts. And again, another person, what do you think about Indonesia? They are down a lot this year and seems to be undervalued.
Yeah, I'm not sure about being undervalued because I think Indonesia's PE ratio is still, I think, 15 or 16 times. So much more expensive than our markets. Pakistan's at less than 8 times. Bangladesh is at 8 times. Sri Lanka is at 10 times. Uzbekistan is at 4 or 5 times. So compared to our markets, still quite expensive. But yeah, as you correctly mentioned, Indonesia is classified as MSCI emerging markets, and yeah, focusing on Asian-centric countries. But I think the reason why it's been down this year is because of the noise about MSCI. MSCI has been quite disappointed with the free float in the Indonesian large caps. And that's why I think a couple of months ago there was a news that MSCI is looking to, I mean, I don't want to use the downgrade, but at least nudge the Indonesian authorities to take some measures to increase the free float. And therefore there were concerns that Indonesia could be removed or downgraded from the MSCI Emerging Market Index, maybe to a standalone index or to a frontier market index. No idea what's going to happen over there, but I think that there's a big concern from foreign investors and also domestic investors on that front. So that's why the market's corrected quite significantly because of these corporate governance concerns about free float, and also MSCI and keeping a close eye. I think MSCI was going to make an announcement this month in May, but they postponed the announcement another month, which again led to a lot of uncertainty on their decision making. which led to investor concerns. But yeah, I mean, broadly, I would say, yeah, Indonesia, if you look at the population, it's 250 million people. But even our markets, Pakistan's 250 million people, Bangladesh is 175 million people, younger population than Indonesia, and more attractive valuations. So I would say, I mean, I would stick my neck out and say the consumer stories in countries like Bangladesh, Pakistan, Sri Lanka, Vietnam, Central Asia, I think are much more exciting and much more value much more attractively than some of the ASEAN countries out there. And that's my personal opinion. Yeah, so that's my view on Indonesia.
Okay, thank you. Ahmed, one question for you. Hi, Ahmed. In the case of decreasing Iraqi oil revenues and currency devaluation, is one of the possible outcomes. Okay, I repeat again. In the case of decreasing Iraqi oil revenues and currency devaluation is one of the possible outcomes. What is the impact of dinar devaluation on big banks, stock prices, and net profit?
Thank you for that. I think that's definitely a very, very interesting question and deserves sort of an answer. Now, I think basically lower oil revenues, substantially lower oil revenues, and continued sort of consumption growth, that definitely leads to a pressure on the reserves and ultimately a pressure on the currency. However, the same thing that kept all the revenues down is the closure of Hormuz. So basically, imports will be coming down and therefore less demand on them. Currently, the central bank has reserves enough for 12 months of imports at 2025 levels. So I think even if there are no revenues, given the fact that imports will come down substantially in line with all the revenues, keep in mind three of our largest import destination are China. So almost all of its imports come through the Strait of Hormuz. You have Iran and Turkey, and then Iran in that order. Iran, I cannot see them exporting anything meaningful at this stage of the cycle. And so therefore, I cannot see a pressure yet on the currency. However, even if there was one, looking at the prior examples, companies' earnings, especially banks' earnings, sort of grew at the last time because I think the banks have substantial US holdings in terms of holding Iraqi bonds. So that's Euro bonds. That's a positive for them. But I think the only example I have, which is really like next door, was Iran. When the US pulled out of the agreement, I think it was in 2018 or 2019, the exchange exploded on the upside because what happened was with the fall in currency, obviously that was a free fall currency, very different than anything that might happen in Iraq. But when devaluation happened, the value of company earnings becomes that much more worthwhile. The bank's earnings are not driven by any dollars or anything. They are driven by borrowing and so forth, but by lending. I mean, at least the key banks are. So I don't see a scenario of that in the next 12 to 18 months. And with the resumption of exports, that would alter that picture substantially better. So to answer it really back, I cannot see yet the circumstances for a currency devaluation yet, given the fact that we have a ton of reserves and all of them are enough for 12 months at 25 levels. And since I can't see 25 levels in terms of imports, one, the economy is bound to slow down after, 2.5 very strong years, and also with the closure of the strait. I hope that answers you. If you want more, I'm more than happy to talk about that, in an email or a separate call. Thank you for that.
Okay, there's just another question popped up regarding Iraq. To your knowledge, has Iraq explored alternative routes to sell its oil, so pipelines or whatever?
Yes, I think that's definitely a very important question, and I think really important because really you're looking at what looks like post Strait of Hormuz. Iraq has an active export line through Turkey. Currently, that one is, I think they're pushing it close to 400,000 barrels. That's an ongoing one. That line has a capacity of something like the original capacity is 1.6 million barrels per day. But that hasn't happened yet. Basically, I think the reason why I think this question is very interesting is what happens post Hormuz. And I think post this whole event, the message is quite clear for everyone. Even if the strait opens completely, even if there are no toll charges, no country in the world will, one way or the other, be happy with depending on that. Iraq geography is substantially landlocked. Currently, as I said, we have a line that connects us to Turkey. We are exploring reviving the old line that went through Syria, and are exploring a line to go through Aqaba. So basically exiting two exits on the Mediterranean and one exit on the Red Sea. The government finally activated the investment of the pipelines within to rebuild our pipelines to allow exports to happen. And I think that's the cost of 5 billion or something. And the first 1.5 billion will be funded from a trade deal we have with China, in which by construction for oil imports, and China imports almost a third of our stuff. So that should be covered. So the answer is yes, it's began to do that. It has a line that can be active, but what I can see post Hormuz is I can see a substantial investments that will pay for themselves in exploring these alternative routes. Iraq will be doing that as well as other countries.
Okay,
So
great.
I hope that answered you.
Yeah, and then just follow up another one for the next question, which goes to different markets. What is the GDP growth outlook for Iraq?
Well, I think this year is going to be up in the air, because keep in mind our GDP, 60% of it thereabouts, is driven by oil production and export. So that would be there. Prior to that, the assumptions for using the IMF, they were looking for overall GDP growth 3.1%, and they were looking for non-oil to decline by 6.3%. To put that in perspective, we had a tremendous 4 years in non-oil GDP. The non-oil GDP grew by 4.5% in 2021, followed by 1.7 in 22, followed by 13.8 in 23, and then 2.5 in 24. So, and 25 was down. Sorry, 25 was down 6.3%. The outlook initially for 26 was a flat, like minus 0.1. I think these will be revised. And I think it's anybody's guess how much, because it depends on oil production. From anecdotally, in terms of consumption, in terms of company activities, I haven't seen any slowdown, and I can't see logically how that would change. But I would wait for the experts at the IMF to revise those figures.
Yeah, so the question is actually, what is the GDP growth of your key markets? Pakistan, Uzbekistan, Iraq, Vietnam. So Iraq we have answered. Vicente talked about the GDP outlook by the government for the next couple of years. So it's 10% for the next couple of years. So that is done. Maybe Ruchir, if you want to talk about Pakistan, I don't know, Uzbekistan, Bangladesh, and Sri Lanka.
Yeah, sure. I think, following on from Vietnam GDP growth, I think realistically 8% is quite doable. The 8% GDP growth in the first quarter. Uzbekistan, as I mentioned in my slides, first quarter GDP growth was 8.7%. So I think very strong momentum. So I won't be surprised if they do any between 7 to 8% GDP growth in 2026. And this is coming off from, again, about 8% GDP growth last year and more than 7% in 2024. So it's not that they were growing from 2% now to 8%. So still very strong momentum over the last few years and also this year. And also in the case of especially Pakistan, Sri Lanka, or Bangladesh, Pakistan, Sri Lanka. And the reason why I'm so favorable on these markets is their GDP growth is only coming off a low base. So for example, the countries coming out of a crisis only now in the last probably 1 or 2 years. So in Pakistan's case, until 2 years ago, they were doing basically no GDP growth. In fact, it's slightly negative. So the forecast for this year is about between 3.5 to 4%, coming from about 2.5% last year, and in 2024, basically flat growth. And Sri Lanka as well, 2022, 2023, negative GDP growth, and then 5% GDP growth in 2024 and 25. And I think this is also between 4 to 5%. So again, and Bangladesh, in my view, is still, the economy is only bottomed out now, basically in the end of 2025, beginning of 2026. So in fact, amongst all these three countries in South Asia, I think Bangladesh can show the highest growth with the 2-year view, because they're still coming off much low base compared to Pakistan or Sri Lanka. So I won't be surprised say in 2027 onwards, they start 26% GDP growth. But for this year, again, 4 to 5% GDP growth. So broadly, I think coming back to my point, Bangladesh, Pakistan, Sri Lanka, the whole story here is the macroeconomic recovery is only just starting now, and that's why they have a strong platform for the next 3 or 4 years. And hence, what's going on in the Middle East, yes, it's a concern, but I'm not so concerned with 3 to 4 year view on these countries because the macro is strong and the political stability is there for a platform for growth going forward.
Okay, thank you. So one finally for Vicente, from a very good friend of mine. I know he's a big supporter of our company. Vietnam, despite recent potential upgrade, why are there continuing sellers or why are foreigners continuing selling? Why are foreigners selling despite increase or the upgrade of the market?
That's a really interesting question. Actually,
But it's not only in Vietnam, basically. I mean, that's also a miracle. I mean,
yeah. So I think
it's in all our markets. Foreigners are continuously selling. Yes, and that's also, and Ruchir mentioned that. I mean, is also providing some strength that now locals are jumping into the void and are actually buying from foreigners. So even if something dramatic happens, I mean, the big holdings, what we have seen maybe 10, 20 years ago by foreigners has been reduced dramatically, and now for local participants or their investors or their pension funds or whatever, there's now pension funds or funds schemes in those various countries. They're jumping in and are buying from the foreigners. Okay, sorry for the interruption. So why the case in Vietnam?
You are right. First, because of the short-term risk from the global geopolitical, the war in the Middle East, the worry about the oil shock, the interest rate, everything. So inflation is also a part of the short-term worry. But I discussed with many brokers of the market. They also say that because Vietnam officially upgraded to EM, so many frontier funds, they have to reduce their position in 23 stock already added into the EM baskets. So at the same time, the frontier fund has to reduce their position. Meantime, the EM fund has to wait until September 2026 until the 23 stock added into the basket, so they started to buy. So the reason why it's created a gap, a time gap between the frontier sellout and the EM buy after September. So this is one of the reasons to explain why the foreigner continue to sell. Of course, other reason, as Thomas already mentioned, because of the geopolitical risk and the short-term risk, blah, 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 something like that. Yep.
Okay, and there's another question regarding Vietnam. Do you think that the AFC Vietnam strategy can benefit from the emerging market upgrading?
Yeah, I think absolutely sure, because is first we benefit generally with the whole markets when the new inflow put into the markets. Of course, the markets will be absorb the new inflow, and the investment sentiment of local individual investor will be much better. In detail, at the moment in our portfolio, we have roughly 6 positions among 23 positions will be added into the EM basket. So it's created a very, how to say, positive and good outlook. So we think that we will benefit from this. Yep.
Okay, great. Let's hope. Scott, a question for you. Are you guys interested in any of the portfolio companies from Uzbekistan, or are you investing directly in Uzbekistan? So 2 questions.
Yes and yes. We have some exposure to the UZNIF portfolio companies that are listed, and then we're also investing in the deal. I think it's super attractive, but I've also been asked by a handful of people, why not just invest in UZNIF? And The answer is very simply because Uznik gives you exposure to part of the economy, but then you have a handful of private companies, especially in financial services, a bit of materials that are not in Uznif, and then equally some of the portfolio companies in Uznif, we have larger weightings in our own portfolio, which you wouldn't be able to replicate by just owning the fund. So we get additional torque to some of the better companies in the portfolio that are listed. One of them being the Uzbek Commodities Exchange, which we've owned since 2018 and has been a superb performer. So about 40% of Uzex is in Uznif, but it represents an insignificant amount of their NAV. So we get better torque to things like that. So yeah, we own some of the portfolio companies and we're also subscribing to Uznif.
Okay, then since you're on the line, what do you see as the major structural risk currently in broader Uzbek economy that may counter argue against your current conviction in the country? So, what could derail?
Right now, God forbid something happened to the remittance industry. That's probably the biggest one. Gold is not going down. If it goes down in a short-term crisis later this year, for example, it will bounce back higher with more global money printing. So the macro is good, but remittances, again, is roughly 20 billion of the economy, and that has fed so much in over the past few years into domestic consumption, not really in Tashkent, but in the regions, and it supported that in lieu to a degree of manufacturing investment. So by sending 4 to 5 million people abroad, if there was an incident or something that caused countries to say, we don't want Uzbeks in the country anymore, that would derail the situation. But there's also checks and balances in the country to ensure that that doesn't happen. But that would probably be one of the bigger risks. So again, otherwise something politically happening, but I don't see that as being a risk anytime soon. So yeah, it would be around the remittance issue.
Okay, still a lot of questions. We have just a couple of minutes. Vicente, how can oil shortage damage the Vietnamese economy? Or what's the impact of oil shortage? You're on mute, Vicente.
Sorry.
Yeah, sorry.
Yeah. First of all, Vietnam is the net imported oil country. However, we also have our own oil reserve. At the moment, every single year we import the sources roughly around 10 billion US dollar. So of course, the oil shock will impact the Vietnamese economy through the much higher producing cost and consumer cost. But the government is right now control the CPI by supporting the farmer and most likely the farmer, because rice price and pork price contribute roughly around 40% the GDP, the CPI in Vietnam, and those two products are still very under control. At the moment, the CPI of Vietnam is roughly around 4%, so it's still under the target of 5% this year. So I think that the government can control this. However, if the oil shock go up like 150 or 160 US dollar per barrel, so we have to adjust our CPI. Otherwise, everything right now is under control. Yes.
Okay, great. Good to hear. So last question, we are approaching the deadline. Also from a very good friend and supporter of AFC. Middle East, that's to Ruchir. Middle East migrant labor has been impacted by the war. Do you see signs of lower consumption in Pakistan or Bangladesh related to this? Or also, that's my addition, do you see less remittances in these countries?
That's a great question. Actually, there was a concern, when the conflict began. But so far, what we've seen, the numbers especially in Bangladesh and Pakistan, have been fantastic. And in fact, Bangladesh had its all-time high remittances in March, and same for Pakistan. Of course, we had Ramadan as well in March, which is one more reason why the remittances were strong. But also for April, the momentum has continued. So I don't see any slowdown in a large fashion. In fact, historically, given that we've had many incidents, political shocks, geopolitical shocks, macro shocks the last few years, when there's crisis in these countries or there's crisis globally, then people tend to send more money back to their homes, because I think they tend to save a lot as well. So even during the pandemic, we saw remittances grow quite strongly in Pakistan and Bangladesh and in Sri Lanka, and even during the war in Ukraine, we saw remittances being quite stable. So yes, there's been no major impact or as such. And in fact, just anecdotally, I don't think the South Asians or in general the people who are working in the Middle East have really left the country. In fact, they're still working there or sending money back home. So a short answer is no, the remittance impact is not there yet, and the remittances have been quite strong for the last 2 months.
Yeah, and obviously to answer, that's my question from our friend. The question is, so obviously people save in the Middle East and send more money back to Pakistan, Bangladesh, Sri Lanka. Yeah. Okay, great, very interesting. So this concludes our webinar today, and since we still have some unanswered questions, we will answer them directly by email. And if you have further questions, please send them to us. You can always reach us by email. You can also access the recording of this webinar at the previous webinars, among other interesting postings on our website, www.asiafrontiercapital.com, or on our AFC YouTube channel. I hope you enjoyed this webinar. We will continue to hold quarterly webinars later this year, and we will announce them in one of our upcoming monthly newsletters. Good afternoon, and good night to our viewers in Asia.